Hi members, and welcome to our live webcast where we're going to cover off all the frequently asked questions about our separately managed accounts. Now, my name is Sneddon. I'm the head of InvestSMART's portfolio services team. And how I've composed this, or compiled I should say, this presentation is basically from all the most important questions that when people are sitting down meeting with me to discuss the separately managed accounts, all the questions that that come first and foremost from them. And so yes, we'll put that together in this next 10 to 15 minutes of a presentation, and then after that we'll go into your questions that you've submitted in the question and answer section, which is just below the live video feed there. So just put your username in and then submit your question, and we'll get around to those towards the end of this presentation. If I can't get to all of them, do send through an email to me and I'll get straight back to you. Now, during that section, I've got my co-host here, John Conroy, who will be helping me out with taking your questions. Now, let's skip to the very first slide. Now, this is the most important slide of the entire presentation. It's our disclaimer. Today, we'll be talking about your portfolio and portfolio management. We'll also be discussing some of your questions, and now I'll be able to talk about those in a very general terms, and we can't give any specific financial advice, of course. So do read over this disclaimer because, as I said, it's the most important slide you'll be seeing all day. Okay, so now getting into what this topic is about, what is an SMA? What is a separately managed account? Now, I generally think when discussing what an SMA is, the best way to start is by telling you what it's not. Now, a separately managed account is it's different. It differs from a managed fund by the fact that, well, one, it's separately managed. So with a managed fund, you are all in the one bucket, so to speak. You're all unit holders invested into the one managed fund, which is then, of course, managed by a portfolio manager to achieve that specific outcome of the fund. Now, that has its drawbacks. It has its benefits, but it also has a lot of drawbacks. And the reason why we chose the separately managed account structure is to better manage those drawbacks. Now, you can see on the screen here, initially, one of the first ones is tax effectiveness. And when you're in your own account, it is much more tax efficient. Now, a good example of this is, say, a managed fund has had a really good 11 months of the year. So coming up to June, the fund's, say, done 10% or something, and you've just then invested at the start of June. Now, for the rest of the month of June, imagine that the managed fund performance has been flat. And so come the end of year, when they're doing the tax statements, the fund actually has all these gains and income as well that it's earned. Now, because you're a member of that fund at the end of the year, you're going to be left having to pay tax on income and gains that you never actually received. So with an SMA, a separately managed account, because you're just in your own account, it's your bucket, that is it. You only pay tax on income and capital gains or realised gains that you yourself have earned. And that's really important. Now, secondly, the other point we've got here is that the separately managed accounts are not impacted by the decisions of other investors. Now, what this means is with a managed fund structure, you have constantly got investors coming and going from the portfolio. So therefore, you've constantly got investors putting cash into the portfolio and taking cash out of the portfolio. Now, a manager can't control when they get those cash inflows and when they have outflows coming out. Now, you can imagine what investor psychology is like. The majority of the time when managers are receiving cash into a portfolio, it's when the markets run hard. It's when everyone's talking about it. It's when it feels good to be invested. And that typically is the exact wrong time that a portfolio manager will want cash. Now, conversely, when someone is pulling money out of a fund, it's generally speaking when it doesn't feel good to be invested, and that means when the market's low. But from a manager's point of view, it means when there's the most amount of opportunities around. Now, think about that and how that can impact your own investment. Even if you're happy to remain invested through the low periods, your fund manager is getting redemption requests sent in. Now, they need to have a certain amount of cash to meet those redemption requests. If they don't have that amount of cash, then they'll need to sell stock to create it. And therefore, it'll crystallize losses and negatively impact your performance. So even if you're happy to see through the good times and the bad times, your performance will be impacted by everyone else around you. Now, if we go over across to the separately managed account space, say another GFC happens, you could be very happy to sit through that period, even add more to your portfolio and ride it through. If someone else panics and wants to sell, the manager can just instantly sell their holdings and their holdings alone, and it doesn't impact you whatsoever. And then the other main point of why we've specifically chosen to use a separately managed account rather than a managed fund structure is to have greater flexibility with the way that you receive your income. Now, income's incredibly important to many of our members, because we've got a lot of members who are use self-managed super funds and are in pension mode. So of course you need that flexibility to be able to take take income and payments. Now, with a managed fund, to receive payments, you have to wait for the distributions. They typically happen twice a year. And then in the between times, you'll need to sell down units to actually realise capital and to pay yourself your, say, monthly, your ongoing expenses. With a separately managed account, just as if you are managing a portfolio of stocks yourself, you can choose to have the dividends that those stocks pay transferred out directly into an account of your choosing. You can have them reinvested and they go back into the cash component, and then they're redistributed across the portfolio when a rebalance occurs. But just as you would manage your own portfolio, you can have that cash sent directly to you as the dividends are paid. Now, if you do require, say, monthly drawdowns, you can set up a regular monthly withdrawal, and that'll rebalance the portfolio and take cash from the portfolio and distribute it to your account of choice. Now, you can also then do ad hoc withdrawals as well. So you've got the dividends coming to you directly, you can have a monthly set amount, and then you can do ad hoc payments to yourself whenever you need. So just like, say, you're managing your own brokerage account. So that's really, really important. And so that takes us to the next slide of income and how you receive it. Now, one thing that I haven't mentioned on that one, and it's really important to note as well, is how you receive franking credits. Because of the separately managed account structure, you own the individual stocks. And what that means is that you receive franking credits when you go and put in your tax return. So if we now jump ahead to the legal structure of a separately managed account. Now, as I mentioned, you are the actual beneficial owner of the underlying holdings within the portfolio. So say if you invest in the Intelligent Investor Growth portfolio and we hold 26 stocks there for you, you are the beneficial owner of those stocks. That means you've got full entitlement to the dividends coming out, and as mentioned, you've got full entitlement to the franking credits that come out. And if at any point you wish to leave the structure, you are able to either sell down those stocks and we transfer out cash for you, or because of the separately managed account structure, you're able to transfer those to a broker of your choice, and you can then continue on to manage your portfolio. Now, with the legal structure as well, we do use a third-party custodian for your protection. That custodian that we choose to use is HSBC. Now, if anything was to happen to InvestSMART Group, we are a publicly listed company, but heaven help it if something came up that was unexpected and we cease to exist tomorrow, your stocks would remain your stocks. So if you will be contacted by the custodian, HSBC, and they will then ask you to do what you would like to do with your portfolio. So at no point in time are your holdings under threat from us. And the SMA is governed, of course, by the Corporations Act, which is there to protect investors' rights. Now, we'll go on to the next slide here, and we've just got some more handy points that investors maybe, are some pivotal points that people do ask when they're sitting in a meetings with us here. Now, the fees always come up. I think just behind the income question comes the fee question. And I think it's a pretty good story for us to tell. Our fees start at 0.97% per annum. That's the maximum amount that any investor will pay with us. And they do then go down to, on a sliding scale, down to 0.65% per annum. Now, how these are charged and payable, they're calculated on a daily basis on the value of your portfolio, and they're then charged from the cash component on a monthly basis in arrears. Now, the other really key point to highlight here is the fact that we do not charge performance fees. And that's a big differentiator between us and a number of our other fund managers out there. The performance that you earn stays 100% in your pocket. And that is a big point of difference, and that will impact your returns significantly in the future. Now, another point as well of how do you actually see your portfolio? The benefit of a separately managed account as opposed to a managed fund is the fact with a managed fund, you only get to see what the fund manager chooses you to see. So, for example, you'll only see the top 10 holdings, or in some cases, you'll only see the top 5 holdings, and that can be, in a number of instances, only on a monthly basis. Now, with the separately managed accounts, there is no hiding. You see every single transaction, you see every single stock you hold, you see the exact weighting that it's held to and the exact number of shares you hold in each stock. And how you do that with us is not through a separate login. You just go simply into your InvestSMART account through the standard InvestSMART login, and you go to the My Portfolio section, and you'll be able to select your diversified SMA. That'll take you through to all of your holdings. Now, we take the transparency even a step further, and we have it so you're able to actually click on the stock code, and not only, of course, are you able to see what you hold, but when you click on the stock code, it takes you through to all of our latest research on that particular holding. So we take it a step further by showing you our exact thoughts, so you know at any point in time exactly why we are holding the stocks we're holding in your portfolio when it comes to the intelligent investor portfolios. Now, when it comes to tax time, another key question from clients is what happens at tax time. We prepare a full comprehensive tax statement for you, so you simply need to pick it up and then put it down on your accountant's desk. We'll email this to you, so it can even be as simple as you hitting forward on that email to your accountant. And then, of course, once the tax return is submitted, you'll get all the franking credits owing to you. Now, we'll go on to the next slide with the differences between our portfolios. If you go onto the website and under the investment ideas section, you'll see that there's approximately 10 different models that people can invest in. 2 of these models are run by the Intelligent Investor Analyst team, and they're identified as the Intelligent Investor Growth Portfolio and the Intelligent Investor Income Portfolio. We then have another 8 portfolios, and they're the InvestSMART Diversified Separately Managed Accounts. Now, we have portfolios there designed to get a specific outcome for your risk appetite and where you are at your particular point in life. So we've got a conservative portfolio, an income portfolio, a balanced portfolio, a growth portfolio, and a high growth portfolio. On top of that, we then have asset class specific portfolios. So we have a property portfolio, a fixed interest portfolio or fixed income, and we have an international portfolio. So the difference between all these are as follows. With the Intelligent Investor portfolios, these are hand-picked stocks. They're direct Australian equities, and the portfolios typically are fully invested. By fully invested, I mean you'll generally speaking be holding around 95 to 97% equities. So you've a highly concentrated portfolio there. With the InvestSMART diversified portfolios, we're using exchange-traded funds to invest across a broad exposure of asset classes, including cash, to give you a broad mix of investments depending on your specific risk appetite and which portfolio you've decided to invest in. The difference between, say, a conservative and a growth portfolio is just how much of one ETF you'll have compared to the other. Say you might, in a growth portfolio, have more Australian equities than you will have, say, bonds and fixed interests. Now, the next slide here is the investment process. Now, sticking with the Intelligent Investor process, if you've read any of the research that comes out from that team, you'll understand that they use what we call fundamental analysis. So using some lingo, it's bottom-up stock picking. When I say bottom-up, I mean you're looking from the ground up at these stocks and going through the balance sheets and the annual reports to identify quality investment opportunities. And they use a value investing approach. So they'll value a business and they'll try to buy something for less than what it's worth. It's essentially trying to buy $1 for 80 cents. And of course, these portfolios are benchmark unaware. What I mean by that is, yes, they do try to outperform the All Ordinaries Accumulation Index, but to do so, they will not be out there buying, say, the banks to a certain percentage because they're in the All Ords Accumulation Index. They'll be buying the best possible undervalued stocks that they can to beat that benchmark. They won't be attempting to match it, they'll be attempting to exceed it over a period of time. Now, with the InvestSMART diversified portfolios, they are benchmark aware. They start with the Morningstar benchmark for balanced or for growth or for income. And then our investment team on that side of the business, which is led by Paul Clitheroe, our chairman, will decide to go underweight or overweight certain asset classes dependent on the risks associated with them and the return that we can see our portfolios getting. Now, capital protection is at the absolute core of these portfolios, and hence why we have a broad diversified exposure within these. These portfolios are certainly not designed to shoot the lights out. They're not our high performance portfolios. That's the Intelligent Investor portfolios. These are portfolios to give you broad diversified exposure and to safely achieve your investment goals. Now, on the next slide here, we've got why you would use the portfolios. When it comes to the Intelligent Investor portfolios, it is quite simple. They're Australian equity portfolios, they're highly concentrated, and you'd look to use this portfolio as your Australian equity exposure. And you'd look to use them for outperformance. That's what you're hoping to see from these particular portfolios. You want to see the Intelligent Investor portfolios do better than what you can at home. And you'll use them because you either don't have the time, you don't have the skill, or you don't have the will to be able to put in that time to achieve the same results. So that's why you'd use the Intelligent Investor portfolios. And we've got growth and income there. So if you are after more income, then of course the Intelligent Investor income portfolio would fit the bill. Currently there's only 6 stocks different across the Intelligent Investor growth portfolio and the Intelligent Investor income portfolio. And the reason is because they both follow a value investing principles and they both have used the fundamental analysis. And so the only stocks that are different are ones that say we see a higher upside in the growth aspect but do not pay a dividend. So naturally they won't cross over into the income portfolio. Now, why you'd use the InvestSMART diversified portfolios is basically because I'd say a lot of people don't have the discipline or the temperament to have a thoroughly diversified portfolio and to actually rebalance it. So that is, if you really want to truly set and forget and not worry about your portfolio as a whole, and I'm talking about international equities, Australian equities, cash and fixed income, then that is a very good set and forget style of investment, because underneath the scenes there, our investment team are tinkering away, changing the weightings here and there, and rebalancing on your behalf. So that's something that a lot of investors have trouble with. Now, another reason why people would choose to use the InvestSMART diversified portfolios is to plug very specific gaps in their portfolio. They might be comfortable using, might be comfortable doing the Australian equities side of things themselves, but be a duck out of water when it comes to investing in international equities. So hence why they just buy into the international separately managed account, and away they go. Now as well, the InvestSMART diversified portfolios are similar to a portfolio that, say, an advisor would put together for some people, but of course this comes at a much cheaper fee. There's no advisor fees associated with them. It's simply just the management fees associated, which, as we said, start at 0.97% per annum and go down to 0.65. Now, if we go to the next slide here, you can see I've put together a slide of how investors can use our portfolios. Now, as I mentioned before, you might use an individual portfolio to plug a gap in your overall portfolio. Now, how you can identify those is by going on and using our InvestSMART portfolio manager. I would highly encourage you to thoroughly input your holdings and do it carefully so you actually get the best view of your portfolio. And that way it'll be able to tell you where you're underweight and where you're overweight, and where you have specific gaps that could potentially hurt your future returns. Now, once you've done that, you might identify that you're terribly underweight international equities or fixed income. A lot of people generally are. So you can then say, okay, I'm going to go out and buy into the InvestSMART diversified international SMA, and that will give you that exposure that you need. Now, one thing that we didn't cover off previously was the minimum investments into these portfolios. You can plug those gaps there for a minimum investment of $5,000. So you don't have to be a wholesale or sophisticated investor that starts out at $500,000. You can come in and get the exact same benefits that everyone else does with us for only $500,000. Now, once again, you might also just choose to use the Intelligent Investor Growth or Income portfolios simply because you don't have the time or the inclination, and you enjoy and you like what our Intelligent Investor team have been able to do over the years. Now, the next slide here, it's called the best of both worlds, and what I mean here is the fact that you do not need to use just one model. You don't need to just have a balanced portfolio and let that be that. You can come along and you can say, okay, I like the diversified approach of the InvestSMART portfolios, but I want the potential outperformance capabilities of the Intelligent Investor Growth or Income portfolios. So instead, you can build your own. So you can have, say, 51%, which I've got here just as an example, of your portfolio is made up of the Intelligent Investor Growth portfolio. You can then plug in the international separately managed account, and then you can plug in the fixed interest separately managed account, and then you might be comfortable just maintaining your own cash balance. And you can input that quite simply into the portfolio manager tool as well, so you've got a complete view of your portfolio. So you don't just have to pick a balanced growth or income to get a portfolio-wide diversification with us. You can use the Intelligent Investor portfolio to add that little bit of potential outperformance for you. Now, the one thing this will not do for you, of course, is constantly rebalance that. That is something that if you choose to go down this option, you will need to monitor, and we will send you an email. You can go into your account settings and tick how often you want to receive that email, but we'll send that to you, and you can then choose when you do rebalance it. And now at this point in time, rebalancing your portfolio is as simple as completing a form that we do have online and emailing into us. And that way you'll be able to we'll then rebalance your portfolio for you to the weightings that you specifically desire. And so that's one way of getting around that. But of course you do still have to keep on top of that. And so going on to the next slide here, the best InvestSMART portfolio for you really is down to what you want to achieve. So from here, go onto the InvestSMART website, upload your portfolio into the portfolio manager, and then complete a portfolio health check and set an investment goal. Once you've got an investment goal, you then know the risk appetite you will need to achieve that. If it's a high goal, you'll know that you'll need more Australian and international equities. If it's a more conservative goal, then you'll be able to dial back that exposure and have more cash and fixed income and have more stability within your portfolio. So I really, really encourage people to get on there and do that, and that'll identify the gaps that you've got, and then it'll also lead you into building a more diversified portfolio using our tools that we've got at our disposal. Now, I know there would have been a whole stack of questions I've probably left unanswered. And so what we're going to do right now is go live with the questions that you guys have hopefully been sending through with my colleague, John Conroy. John.
Thanks, Mitch. Yes, we've had a few questions. Some of these you might have expanded on during the presentation, but we'll just get you to reiterate somewhat. Starting from the top, from some of our earlier questions, and I think you mentioned this, can we see the holdings and weightings of each of the portfolios before investing? Yeah,
you certainly can. So to see the holdings and weightings of the portfolio, you simply log into the My Portfolio section of InvestSMART. And you go to your holdings. It's actually called holdings, and you can see every single stock you hold, every like the amount of shares, the price that they were purchased at, and the weighting in the portfolio. So it's 100% transparent.
Great. And a simple question from Jeff, one to get out of the way early. How can I invest in the portfolios? I guess that's just a matter of accessing it via the website and finding that information.
That's exactly right, John. So once you go onto the website, if you're looking under the InvestSMART ideas section, you'll see for each individual portfolio there's an Apply Now button. And once you click that, it'll take you through to a section of the website where no matter what entity you're investing in, say it's your self-managed super fund or you might be an individual, you can do the whole process online. If you do break down at any point through that online process, we've got a team here that'll give you a call and be able to walk you through it and complete the application with you. And it could even be a matter of completing the application offline with you as well, where we'll send you your half-completed forms and get the rest of the details.
Fantastic. And a question from Vanessa, how quickly will my cash be invested?
Oh, that does depend on how the account is open. Of course, we'll open up an account for someone and you can do a direct deposit or you can BPay it. Of course, if it's BPay, we have to wait for you to send the cash. But people can also transfer in stock as well, so that delays the account opening process. We need to go out to your broker and we need to contact them to then transfer the stock. So that can, when there's more moving parts, it's going to take a little bit longer. But typically, once we have the cash, the next day, the stocks will be purchased. So across the portfolio, you will buy every single stock within the portfolio the very next day that your cash has settled.
Excellent. And a question from Diane. Are the fees consistent across Intelligent Investor and InvestSMART portfolios?
Yes, they are. So 0.97% per annum, that's what they start at. It goes down to 0.65% per annum, no matter if you invest in the Intelligent Investor growth portfolios or the InvestSMART diversified portfolios.
Great. And a question from David we had during the presentation. If you have multiple portfolios in the one account, does the tiered fee structure apply to overall balance rather than to the individual portfolios?
If you're referring to, say, if you've got the one invested entity, say your self-managed super fund, and you have a portfolio that for the sake of it is $1 million, and you've got that broken down into the Intelligent Investor income portfolio, a little bit of the growth portfolio, a little bit of the international portfolio, and say a bit of the fixed interest, for example. We look at it as an SMA as a whole for that fee structure. So no matter how many different models you might have it in, it's all calculated on the one amount. So that $1 million, for example, it'll bring, of course, the fee structure down to, I think it's 0.85% if you're above $500,000. But you must have a minimum of $5,000 invested in each model portfolio that you go into. So I believe that's what David's referring to there. Alternatively, I do have people that have come to us, and for example, they've invested $1 million, but have done so in two different entities. Say they've invested in their self-managed super fund, but they've then invested in their individual name as well. We can't say if you've got less than 500,000 in one and more than 500,000 in the other, you'll be charged these, say, 0.85% on the one that's above 500,000, but charge 0.97% on the one that's below, because they're two different legal entities.
Right. And I guess a follow-on from that, from Ron, can SMAs be used as an add-on to an SMSF? And what is the fee scale from 0.97 to 0.65%?
Can they be used as an add-on to an SMSF? They can be used within your SMSF. I don't know what an add-on to the SMSF would be, but they certainly can be used within it as an investment vehicle. So just like within your SMSF, you'd go to invest in a particular managed fund, you might have 5 or 6 managed funds that you use in your SMSF. You can use a separately managed account just like you'd invest in one of those. But of course, our separately managed accounts come with a lot more benefits, being what we've gone over, the ability to control your withdrawals and when you want cash, as well as the transparency that they bring. I hope that's answered Ron's question. And describing there's 4 different, when it comes to the fees, there's 4 different tiers. Off the very top of my head, Ron, unfortunately, I can't remember every single one, but if you do go to the investments pages within InvestSMART, you'll see there's a fees section there that breaks them all down for you.
Cheers. And one from Richard, who is investing in the income portfolio and wants to switch over to the balance portfolio. Is it possible, and I think you touched on this, to transfer my investment from one portfolio to another?
Yes, so if you go onto the investments section of InvestSMART, you go to any one of the portfolios that we have there. There's a little tab there called Forms. Under the Forms tab, believe it or not, is our forms that you can complete. So complete the form that says to change your model allocation. Select the new weightings that you desire. If it's 100% of one, then to switch completely from the balance to the income, or vice versa, then you write that down. You scan that and email it to invest@investsmart.com.au, and we'll be able to action that for you. You can also print it and mail it in as well if you say don't have a scanner. But whenever you need to change your model allocations, it's just one simple form to do that.
Excellent. And one from Ian, and another one I think you touched on during the presentation. Am I the direct beneficiary of the shares?
I believe Ian's asking about ownership, and yes, you are, Ian. You've got full beneficial ownership of the shares that are in your portfolio, be it the intelligent investor portfolio where you're holding anywhere between 20 to 30 stocks, or say the InvestSMART portfolios where you might be holding, say, 8 exchange-traded funds. You're the full beneficiary of it. You do not have voting rights. We hold those, but we won't vote on our investors' behalves.
And a question from Dev: can I make regular contributions to my investment, or how do I add to my portfolio?
Okay, so just like you're changing model allocations, if you're looking to make a one-off contribution, there is a form that you can do that. I think they start at $1,000. Or if you want to set up a regular contribution, we have a nominated bank account that you've already pre-populated for us in the account opening process, and so you just simply fill out a form and say the amount that you want, and to go, if you've got more than one portfolio, on that form you can delegate what goes into each portfolio, but that must start at $100. So that's the minimum investment there for a regular contribution plan.
Sure. And a question from Manfred: how do I receive the franking credits when investing in the Intelligent Investor Income Fund if dividends are reinvested?
So when you go to put in your tax statement and tax return at the end of the year, your accountant, you'll receive them once you get that return. So that's how you would receive them.
And James asks about the Intelligent Investor portfolios, which seem to have a 15-year performance and could you please explain how the Intelligent Investor portfolios seem to have 15-year performance and SIP year performance that's shorter?
So the Intelligent Investor model portfolios have been running as models for 15 years. They have only just recently, in the last 18 months, been made investable products. So the Intelligent Investor Analyst team have been running these model portfolios, an income and a growth portfolio, and have been selecting stocks for the benefit of their subscriber base, the Intelligent Investor members, for the last 15 years. So previously, Intelligent Investor members have been able to sit at home, read along with what their team are doing, and then invest alongside them by going out and buying the stocks themselves and having to follow the portfolio themselves. Now, the downfall of trying to track a model yourself as a standalone investor is the fact that it's actually quite difficult. You might miss an email and miss the fact that the model's changed, or you just might have natural impulsions where you don't want to buy a specific stock. You might have a view and say, absolutely not, I don't want that in my portfolio. And so it's very difficult to track a model portfolio if you're doing it yourself at home. So recently, in the last 18 months, the Intelligent Investor portfolios have been opened up so that people can actually invest directly into them, so they don't have to worry about missing those emails or missing transactions. So they have a track record going back 15 years as models, and that's been audited externally. However, the investment, they've only been investable for the last 18 months, and so that's how long they've actually been managing real money. So I'd say that's the figure, the performance figures there are what investors will focus more heavily on. But that 15-year track record, to me, shows you that the process has been in place for a long time and has worked for a long time, because I know they've significantly outperformed the market.
Fantastic. Thanks, Mitchell. And just one more question from Darren, and he's just asking about the application process as well, which is largely online, he asks.
It can basically be, depending on which entity you're investing in, 100% online. As an individual, if you're just investing in your own name, you can go on there right now, and I think if you've got your ID with you, you can basically be completed the process in less than 10 minutes. You go on there and you put in your driver's license number, and we verify you online, and you can be invested very quickly. For self-managed super funds, we do need trust deeds certified. So we don't need the whole thing, but we just need the front page of the trust with the name on it, the trust schedule, and the page with the trustee's signatures certified, and then scanned through to us. So it does take a little bit longer, and that's a little bit of a manual process for these self-managed super funds, but on the whole, it's an incredibly automated process that you can do almost 100% online.
Fantastic. That's it from us. Thank you.
Great. Thanks, John. And look, thanks, members, for joining us. If you do have any questions that we may or may not have covered off, please send me an email. My email address is m.sneddon@investsmart.com.au, and we'll catch you soon. Thank you.
I know I need a different approach to investing, and I feel Intelligent Invest will buy stocks that I won't buy myself, and also I think they'll probably make bluntly gutsier decisions than I will.